Just a quick introduction to the series before we get right into it. All respects paid to ICT. I've learned everything I know from him. I've found his concepts helpful in my own trading to help me to become consistent and profitable. And I understand that newcomers, when they want to learn these concepts and they go to watch his videos, it's easy to get information overload. You know, his videos are really long, contains a lot of ranting and waffling that aren't entirely relevant to what you're supposed to learn from those videos. So I think you'll find this playlist, this upcoming series helpful. We'll be doing one episode every single week. Follow along, make sure you subscribe and like the video for more. So full disclaimer, I'm really making this playlist, not for you, but for myself, because teaching these concepts helps solidify them in my mind and helps to help me with my trading. So this is for me, not you. But as a byproduct, it's going to help you too. And I know it will provide immense value for those of you who are brand new, wanting to learn ICT's strategies, smart money concepts, and it will also help those of you who've already watched his mentorship, but just want to tie everything together and have more bite-sized, digestible pieces of information that help really solidify it in your mind too. So switch to the screens now. Episode 1, we'll be looking at the strategy itself and how to trade it on the charts. Okay, so here we are. Episode 1, ICT Concepts Simplified. The strategy. So we'll be looking at how to trade the ICT strategy in the charts. Okay. So getting right into it, you want to start with the weekly chart. So the aim is to get a read on where the weekly candle is likely to draw to. So you're not trying to predict exactly where it will close, but you just want to get a general idea for where the general direction of that candle will be. Are we going to be going up or down for the week? So you can see here, as we see, we've had a run up here, green, 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 and then things have started to dip a little bit. And you could say that, that we might be looking for a little bit of a pullback after this bullish move up, breaking this high over here. You could say that this week we're looking for a red candle, so we might just, have the idea in the back of our head that we're looking at a potentially bearish week this week. So it's tough to always get this 100% correct, but you really get a feel for this over time. So that's it. You start at your weekly chart on TradingView. You look for any areas, any hints that you might get as to where the weekly candle might go. And as a tip, you can look for areas that could act like a magnet for price. And that's typically imbalances, liquidity voids, relative equal highs / lows, etc. We'll cover this more as we move through the presentation. Right, so after you've done your weekly chart and you've got your weekly sort of bias going, you want to switch down to the daily chart and frame your day. So every morning, every day you trade, you want to be starting from the daily chart. Majority of your analysis should be done here just to figure out where price is drawing to intraday. So smart money, they typically, like institutions and whatnot, they'll typically look at old daily highs and lows for pools of liquidity. So always mark out the previous day's high and the previous day's low as a point of interest. A lot of the time you'll find that the trading setups that you're going to use from this trading model will occur near the previous day's highs and lows. So mark those out as points of interest. Now typically price will draw towards one of two things, either stops, buy stops, sell stops, or imbalances. We'll cover what those are in just a second, but this is why you want to mark out the previous day's high and low, because these are areas where buy stops and sell stops typically reside. So do that on your daily chart. Moving on to how to identify stops. So this is the daily chart again, the E-mini S&P March delivery contract. If you're looking to identify buy and sell stops, not only will you mark the daily high and low, so if we look at this candle here, the daily low will be here, would mark that out. The daily high would be here, would mark that out. But also, you could look for previous swing highs and swing lows. Here's a significant swing low. Here's a significant swing high. These areas typically where buy stops and sell stops will rest. And in fact, as of today, on my Top Step Combine, I took a trade that actually was based around price sweeping this low, this daily low. Okay, so it's good to have these areas marked out, or at least be aware of them as you're trading. So here's an example of identifying stops. We've got the previous day's low marked out, previous day's high marked out. These are your areas of interest for the current day. And like I mentioned, you can look at old swing lows, old swing highs. Just keep an eye out for these areas as well. And stops typically also will rest around relative equal highs. So if we look at these two candles here, the swing highs are relatively equal. And price doesn't like to leave those hanging around for too long. So typically price will come up and seek these areas for liquidity as well. So be aware of those. And imbalances, identifying an imbalance. A lot of you will know what that is already. It's also known as a fair value gap. And we can also look for liquidity voids. And I'll show you what those are. So a fair value gap is when price makes sort of a displacement move like this and leaves a gap. Okay, there's an unfilled gap here. See the bottom of this wick and the top of this wick above this candle here? It's not overlapping at all, so that's what's called a fair value gap. And typically you'll find your trades are set up in there as well. You can also look at volume imbalances, which is where the candles close and the next candles open are not overlapping. See that? It kind of skips a whole area over here. And in fact, you'll find most candles do overlap. The open and close does overlap. But when you see something like this, typically price will want to come down and cover it. See, price came down, covered this liquidity void here, made another void, covered it there. Okay, so just be aware of those areas. And here they are marked out. That's your fair value gap. Bottom of the previous wick, top of the wick after a long candle down or up. And liquidity void over here. So after you've marked out the daily chart with those things in mind, you want to drop down to your 15-minute chart. And this is where we're going to be hunting our setup. Okay, so on the 15-minute chart, you're going to be looking for sweeps of liquidity, which is, again, old highs or lows, relative equals, or even areas of imbalance. And as you can see here, I've marked out Wednesday's high, so the previous day's high, the previous day's low, like we mentioned on the daily chart. You mark those out. Now, once the sweep occurs, you want to drop down to the lower time frame to hunt your actual entry. And typically the 3-minute, the 2-minute, and 1-minute chart will be your best bet to find your entries. ICT teaches that most high-frequency trading algorithms actually operate on nothing higher than 3-minute windows, and we want to be trading with the algorithm, so those are the time frames we want to be looking at, okay? And as you can see here, we've got Wednesday's high, Wednesday's low, then we move into Thursday over here, and what happens? Thursday, Wednesday's high gets swept, okay, that liquidity gets taken out before it makes a big push to the downside. Wednesday's low gets taken out, swept, before it makes a big push to the upside. And you'll find this happens very frequently. Now, these areas after the lows and highs are swept is where we'll be looking for our actual liquidity to reside and where we'll be looking for our setups. Because as you can see, once those areas get swept, you typically get large moves that you can catch some handles, some ticks, some pips off. So after you've got those areas marked on the 15-minute chart and you've found your liquidity sweeps occurring, immediately drop down to the lower time frame. For this one, we'll use the 3-minute chart just as an example, but use, like I said, the 2-minute and 1-minute chart are great as well if you can't see anything on the 3-minute chart. So here's the checklist. If you're taking notes, write this down. This is your trading model right here. So we've got Wednesday's low, the previous day's low. On the 3-minute chart, we can see price aggressively move down, swept for liquidity, consolidated, accumulating orders before making a push to the upside. So as we can see, liquidity swept, yes, the previous day's low was taken out. Now, next, we're looking for a shift in market structure. So how can we tell that? Well, if you look here, the swing high here, and then we had a swing low, that's bearish. So we've got swing high, swing low, swing high, swing low, bearish market structure. But as soon as we have a swing low, and then price pushes past these swing highs, that's what's called a shift in market structure. The market's now changed from bearish back to bullish. Okay, so that's what we're looking for. And then after that shift of market structure has occurred, you want to be looking for a fair value gap or an imbalance. So as we look here, at the imbalance or the fair value gap will always form where the price had caused this market structure shift, okay? So from the low to the high of this market structure shift, we're going to be looking in here for a fair value gap. Now, can you see one? Wicks overlapping, no gaps, no gaps. We get this candle here, and what do we have? A gap. The previous candle's high stops here. The following candle's wick, the low, stops there. So we've got a unfilled area in here. So once that fair value gap is created, you want to enter a trade in this fair value gap with your stop loss at the fair value gap candle's wick. So the low or the high, depending on if it's bullish or bearish. Now, some people, if you can't handle that much risk and you want a bit more space, you can use the wick beforehand, but I find the fair value gaps candle is just fine, especially on the E-mini S&P where price is less volatile than, say, the NASDAQ. Okay, so if we look at the next, so before we continue, keep a note of that. This is your trading strategy. Okay, this is what you're looking for every single day, and this strategy, this setup will happen basically every single day as well. So, like I said here, we've got it marked out just to solidify it in your brain. There's the previous day's low. Price has swept the low, consolidated, boom, pushed through those other swing highs, causing a shift in market structure, a market structure shift, MSS. Okay, so we've pushed through, and then we found what? An FVG, a fair value gap in this square right here. And so keep your mind right here. It's come down. Typically, I like to enter a trade as soon as price touches the top of that fair value gap, I'm in the trade most times. So here it is marked out. There's your fair value gap from the previous screen. We enter our trade, and price has a little bit of drawdown, but it ultimately doesn't break the low of the fair value gaps candle, so it's still valid. And then price pushes up, and boom, hits the target. 22.25 points for that's 89 ticks. So our take profit is at the swing high over here. Okay, risk reward ratio of 4.24. So that's how you trade the model. That's how you get into a trade using fair value gaps. Now, you might be asking, why are we taking profit here? Why is this the take profit area? Well, ICT teaches that for you to target old highs or lows as profit targets. And you want to take the low-hanging fruit, so the most recent opposing high or low. So as we can see back on the screen, as soon as price pushed through these, there's no swing highs anywhere here. So the nearest swing high is right here where liquidity will be resting. Price will be seeking the buy side liquidity now. So that's why we've targeted this as our target. And price, although it took a while, eventually hits that target area. Okay, so that's one way you can do it. Personally, I like to take profit at just 5 handles. I take small moves. It's 20 ticks. This works for me, and it helps me stay consistent and profitable. Based on my back testing and my trading personality, I like to be in and out quick and not hold trades for too long. For me, nothing feels worse than a trade reversing all the way back to my stop loss after a decent move in my favor. A lot of the times when I used this model, when I first started out anyway, and I was targeting old highs and old lows, price would often come up, get so close to my take profit, then reverse. So this model is not always going to work, but what is always working for me, at least very consistently, is 5 handles. So I'd be taking profit likely around here. Okay, and that would give me like a 1 to 1.5 ratio, risk reward ratio, which is just fine for me. Okay, so you decide on that. You have to find what works for your trading personality. A lot of people do use this method of targeting old highs and lows. You do get bigger moves, but I just find I get stopped out a lot more frequently, and that's bad for my psyche. I prefer to win often and win, reasonably sized, kind of small, but consistently. That just works for me. So that's this strategy simplified. Thank you for watching. we'll be looking over episode 2 next week, and we'll be covering some more concepts, key concepts. There's other tools you can use to frame and confirm this strategy. So look out for those. We'll be looking about ways you can more confirm your entries with this model. So that's coming next week. Just to close off the video, just to let you know, I am an official Top Step partner. So if you're looking to trade futures seriously, you can go with Top Step, and they will fund you, and you get to keep 90% of the profits after you pass their evaluation, and you can get started for as little as $165. So if you use my link, the link will be in the description and the pinned comment below. You'll receive 20% off your trading combine, and that just helps support the channel and supports the content that I'll be putting out more for you. So if you're looking into getting funded, I highly recommend you go with Top Step. Do your own research, but they are the firm that I use as well. So highly recommended. Anyway, thanks for watching, and I will catch you all next week.